The first mistake is valuation. Let's say you buy a stock at an expensive price. That means that the market is very optimistic about the future of the company. If the results of the business are not as good as expected, people will be much less optimistic and the high valuation will not be justified. So people will sell the stock to a more reasonable price. That means that the higher the valuation, the bigger the shock if something bad happens. It's like a rubber band, and the tighter it is, the better the effect. How to know if something is cheap or expensive? Keep in mind that the average P/E ratio for the S&P 500 is around 15. So you have a rough idea of valuation. If something has a P of 30, you can say it's expensive. And if something has a P of 3, you can say it's cheap. It always depends on the situation, but now you have a rough idea. To give you an example, in 2022, Netflix stock had a P of 50. Everybody was optimistic about the business and something happened. The growth in users weakened, the profitability was in danger, and the competition was stealing market share from them. And this shock caused a drop of 70% of the stock price, which led the P/E ratio from 50 to 15. That was brutal. So the big idea is to not overpay. And it doesn't matter if the business is good or not. In 2000, Microsoft was a wonderful company. It was a good and predictable business with good earnings growth. But the valuation was too high, with a P/E ratio above 60. Even though the business grew, the stock did nothing for the next 16 years. The second mistake is especially relevant for new investors. It's easy to get overconfident, especially when you've had a few successful investments. But overconfidence can lead to reckless behavior. Remember, nobody can predict the stock market, even the best investors in the world. A lot of people started to invest during the pandemic, when the markets only went up. In 2020 and 2021, they made a lot of money. They thought it was really easy to invest, and markets will always go up. You know what happened next. 2022 was a difficult year for everyone, and these new investors didn't prepare for it. Overconfident investors took on excessive risks and lost everything.
I'll take meme stocks. Invest!
Being overconfident can lead to unnecessary losses, and you have to be aware of your own bias. In this field, you have to always stay humble and do your research. Sometimes you think that you are good, but you're just being lucky. Another mistake is
trying to time the market,
which is pointless. You might be seduced to try to predict macroeconomic events in the short term, like the future interest rates, the employment rate, or inflation. But it's easy to get it wrong and easy to lose money on your bet. Instead, focus on a long-term investment strategy. Timing the market is more important than trying to time the market. You know what they say, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Invest regularly and stay committed to your financial goals. Be careful because you can be influenced by the media, by other people. You have to remain rational. And that's a good transition to my next point, being emotional when investing. Allowing emotions such as fear or greed in your investment decisions can lead to impulsive actions and poor returns. Emotions can be your worst enemy in investing, and not being rational can result in buying high and selling low, which is the opposite of what you want. Remember, markets will always have ups and downs. That's the nature of markets. If you stick to your investment plan and avoid making decisions when you're emotional, you will survive. And that's important because you want your money to compound over the long term. If you don't survive, you will not see the long term. To develop this discipline, I usually do something that works. When there is a bull market and everything goes up, I make a list of stocks that I would buy if prices go down, and I write a target price. Then when there is a panic and everything goes down, I go back to this list and I buy if the price is within my targets. It sounds easy when you say it, I know, but when the stock market goes down by 30%, you are not rational and you have plenty of reasons not to buy a stock. You get excuses, all the media saying negative stuff, negative future about the company. You are biased. Having a checklist helps you. My last point is not often talked about. A big mistake is overtrading and overlooking fees and costs. Every time you trade, you pay a commission to your broker. The more you trade, the more transaction fees you will pay. If you don't pay attention to these costs when you invest, it will erode your performance.